Hi, very good morning to everyone. So when students from, let's say, non-finance background or from any other background, when they hear the term like Companies Act or financial statement, generally what happens is that they often feel nervous in that case, right? So it sounds little bit technical, a little bit serious, and little bit difficult as well. But if we remove the complicated words, the idea behind this is very simple. So it is all about keeping our proper records of money and showing those records clearly to the people who have an interest in the business, right? So today, what we'll do is that we'll understand what accounts are prepared under the Companies Act of 1956 and under the Companies Act of 2013. Generally, this 2013 Act has also got amended in 2015, but moreoverly, we will say that we'll use the word Companies Act of 2013 itself, right? And more importantly, we'll also understand that why these changes were made between the two laws, right? That is which is very much important for us to understand. So let us begin with a very simple real life situation over here. Imagine a group of people in a town, they decide to build and manage a private school, right? So different families invest money to start that school. Some people donate funds and a few members take responsibility for managing it. Now, the main idea is that the school collects fees from the students and pays salaries to the teachers. It also buys furnitures, computers, and books. So over the time, the school grows bigger and bigger. Now imagine in this case that after 1 year, the parent who invested money asks some basic questions. And the question is that they want to know about how much money the school has earned between that 1 year, how much the school has spent, and what property the school has owns, right? Whether there are any loans, right? Or they are free from any loans. So they want clear answer because their money is involved in it. Similarly, the management cannot just say that everything is fine in this case. So they must show a written reports with proper numbers because they need to show that. And that is where the financial statement comes in. So when companies work in the same way, but they work in a very much larger scale. So instead of a small school, think of a big company, right, with thousands of employees, crores of rupees that is being involved in that. So investors, banks, governments, they want proper information about its financial conditions. So to ensure that company prepare and presents this information properly, India has a law called Companies Act. And the earlier law was Companies Act of 1956. Later, this law was replaced by Companies Act of 2013 after doing certain modifications into it, right? So under the Companies Act of 1956, companies used to prepare their financial statement according to the Schedule 6. Now, this schedule, now the question arises in your mind, might arise in your mind that the what is the schedule is all about. So generally, this schedule basically provides a structure and the format of for presenting the accounts. So under this law, companies mainly prepare four important parts. And what are those four parts that you can see on the left hand side? The first is balance sheet. So what is balance sheet? These terms might sound technical to you, but let's understand in a very simple manner. What is balance sheet? Balance sheet shows what company owns and what it owes on a particular date, right? So going back to our school example, the school may own land, the school may own classrooms, the school has computers, the school has school buses and money in the bank. These are something which school owns. So these are called as assets which school owns. At the same time, it may have unpaid salaries, it may have pending electricity bills, or it may have bank loans. So these are what school owes to the other parties, and these are called as liabilities. So what is balance sheet? Balance sheet generally lists all the assets and liabilities, and it shows the financial position at a specific point in time. So under the Companies Act of 1956, preparing a balance sheet was a compulsory for every company. Then the second statement which comes under this is profit and loss account, right? So this statement basically shows the performance over a period, usually 1 year. So it records total income and total expenses of the company, right? So in school example, if you see, income would include in the school example like tuition, student fees. The example could be like donations, right? In expenses part, if you look into expenses would include teacher salary, it would include maintenance cost, it would include rent, it would include utility bills. So these could be the expenses for the school. So if income is more than expenses, then there is a profit or surplus. Or other way around, if you look into if expenses are greater than the income, then there would be a loss. So the profit and loss account tells us whether the company is financially successful during the year, right? So under 1956 Act, this was also mandatory. Then the third statement is cash flow statement. So when we look into cash flow statement, sometimes profit shown in the books does not match the actual cash in hand. And thereby there is a need of preparing the cash flow statement. For example, if some students not yet paid their fees, income may be recorded, but the cash has not yet been received. On the other hand, the school may have paid advance rent for the next year, which reduces the cash even though it relates to a future period. So the cash flow statement basically focuses only on actual cash movements. So it shows how much cash came in and how much went out. So under the 1956 Act, this statement was mainly required for listed companies, meaning companies whose shares were traded on stock exchange. Many smaller private companies were not strictly required to prepare this cash flow statement. Then the fourth part comes was notes to account. Now numbers, we have seen that the numbers alone does not give complete clarity. Now suppose the school has taken a loan. Now people who want to know details like the rent interest, the people who want details like repayment period, right, and conditions. So these examples are given in notes to account. So they help users understand numbers much better way, in a much better way, right? So under the Companies Act of 1956, generally we prepare a balance sheet, profit and loss account. And let me tell you, in profit and loss account, there is also one more account which is a sub part of it, and that is what we call as trading account. So generally we used to call it as trading and profit and loss account. We'll understand this also in our upcoming videos. Then we prepare a cash flow statement, and this cash flow statement is mainly for listed companies and notes to accounts. So these together provide a picture for financial position and performance of the company under the Companies Act of 1956. Now, what has happened is that over the time, business condition changes, right? And it has changed a lot. So companies become larger and more complex. And now globalization has also increased. So investors from different countries started investing in Indian companies. And there were also instances where companies misused accounting practices, right? They have hid some important informations, or they have presented incomplete financial pictures. In some cases, it has also been found that the company showed a high profit, but later failed because they did not have the enough cash or had hidden the liabilities. So these situations reduces trust among the investors and the public. So to address these issues, government introduced Companies Act of 2013. So the new law aimed this basically new law. This aimed to improve transparency. This aimed to improve accountability and corporate governance. So financial statement under this act are prepared as per the schedule number 3 and the section 129. So under the 2013 act, companies still prepare balance sheet. The purpose remains the same, to show the assets and liabilities on a particular date. However, if you look into, the format is more detailed and standardized. So the format of presenting the balance sheet becomes more detailed and standardized in that case, right? So this helps in better comparison between the companies and improve the clarity for investors. So today in this video, we'll understand the basic of Companies Act of 1956 and 2013, amended in 2015. But the more numerical part of it, the chart and the format, we'll understand in a upcoming videos. So next comes in the profit and loss account. The profit and loss account was renamed as statement of profit and loss account. So this is one change that has been done. Then the format has also been revised. So while the basic idea did not change, right, but the disclosure requirements become more stricter in this case. So companies now need to provide clearer breakdowns of all the incomes and all the expenses. One major change relates to the cash flow statement, and that has been done under the 2013 Act. Now it became mandatory for almost all the companies except one person companies or small companies or dormant companies, right? So it was not only for listed companies, it is for all the companies except one person company, small company or dormant companies. They are excluded from this part. This change was actually made because profit alone does not show the true financial health of the company. So the idea was same. So the cash is essential for daily operations. And by making cash flow statement compulsory, the law ensures that the stakeholders can see the real liquidity positions of the company, right? Another important additions in this 2013 Act is the statement of changes in equity. And that is one of the most important part. So this statement was not required under the Companies Act of 1956. Equity represents the owner's shares in the company. As we all know, over the time, this amount changes due to the profit earned, dividend paid by the company, additional capital introduced by the company, right? Or reserves created. So the statement of changes in equity basically shows how this ownership amount changed during the year. So this provide greater transparency to the shareholders because they have a separate statement for changes in equity. So over the years, how the equity has changed, how the equity has evolved, right? And how much changes has been done in the equity portions, that every interested party can see clearly now with the statement of changes in equity. So they can clearly see how their investment has increased or decreased during the time period, right? Then we have the notes to account. The notes to account continue under the 2013 Act as well, but the level of disclosure has increased in this. So companies must now provide more detailed information about accounting policies, risks, commitments, and related party transactions. So this improves trust and reduces the chance of hidden information. So the need for these differences mainly arose due to changing business environment, past experiences. So in 1956, if we look into, was suitable for its time, but as company grew, financial system also grown, and financial system became more complex. Stronger rules were required at that point in time. So investors demanded more transparency in this case, right? Government recognized the need for better corporate governance. International accounting standards were also evolving, and India need to align with the global practices. And thereby, these changes become very much mandatory. So the addition of statement of changes in equity also helps shareholders understand how their ownership stake changes over time. So making the cash flow statement mandatory for most companies, ensuring that the cash position is clearly visible to all. So more detailed disclosure generally reduces the risk of fraud and misrepresentations. So overall, 2013 Act aims to present a true and fair view of the financial conditions of the company. So in the Companies Act of 1956 basically provided a basic framework for financial reporting, whereas the Companies Act of 2013, it strengthened and it has modernized that framework. So the purpose in both the laws remains the same. Ultimate aim, ultimate goal is remains the same. But to ensure that the company tells their financial story clearly and very honestly, the differences lies in the level of detailed transparency and accountability. So if you remember one simple idea in this, remember this. Financial statement answers 5 basic questions. And those questions were, what does company owns? First question. Second is, what does it owe? Third question, did it make a profit or loss? Fourth one, how much cash is moved? And the fifth one, how did owner's money changes? So in 1956 Act, they answered most of these questions, whereas in 2013 Act answers them more clearly and more completely. And that is the main reason for this difference between the two laws. So I believe that you might have understood the difference between the two laws, that why this Companies Act of 1956 now has been refined to Companies Act of 2013, and what are the statements that will be preparing in the new Companies Act as per the new Companies Act of 2013, and what changes has been made during these two acts, between these two acts, right? So I believe that this has given little bit of clarity between the differences between these two acts. Thank you so much for joining with us. Thank you.